Hey everyone, it's Tracy here. Welcome back to my channel. So in today's video, I want to go through my dividend growth stocks that pay me thousands per month. Now, I've had many of these for a very long time, and many of them are Canadian companies. I'll share why I own them and a key metric that I zone in to monitor my portfolio. Now, I'm sharing my process because I hope that it makes you become a better investor. Of course, this video is for entertainment purposes only. Please don't take this video as financial advice. Please do your own due diligence. Hey everyone, it's Tracy here. Just in case you don't know me, I'm a former engineer turned full-time investor, but mainly I'm a mother of twins. Now on my channel, I love talking about passive income using stocks and real estate, building wealth, and ultimately designing your best life. So if you want to hear more about these topics, then you definitely want to hit the subscribe button and that bell notification button so you get the latest and greatest videos coming to you every single week. By the way, I want to share a free resource to dividend growth investing. Now, I built this guide for Canadians. So if you want to invest in dividend growth stocks and learn how to do it, see the link in my pinned comment. So let's get back with the video. Now, before I reveal the dividend stocks that I own, I want to share briefly why companies pay dividends and how this relates to the S-curve. Now, this is incredibly important, so you definitely don't want to skip this step. Now, you don't want to fall into dividend traps where you're chasing high yields and then soon enough, if you're relying on those dividend paychecks coming in every single year, it could get cut, which is like death to investor who relies on the annual cash flows. The S-curve is a fancy term meaning business cycle. Okay, so I always look at companies and I think, where is it on the business cycle? Because dividend stocks tend to be in the mature business cycle because typically what happens, they get a lot of profits and they're at a stage that they're not growing very fast. In fact, they're growing probably like snail pace. And what they do is they want to reward a lot of the profits back to their shareholders in the form of dividends. Now, other companies who are in the earlier stages of growth will have very little dividends like Microsoft's and the Apples of the world, or they will use that profits and buy back more shares in the company. So essentially every share that you own of a company that does company buybacks becomes more valuable because you own a bigger proportion of the company. So I have 9 dividend stocks in my entire portfolio. Now, the majority of these companies are dividend growth stocks. And what I mean by dividend growth stocks, it means that they grow their dividends every single year. Now, of course, I'm going to share why I own them and anything that I'm seeing that could raise alarms with each of these individual companies. Now, I forgot to mention one thing about the dividend payout ratio. This is going to become super important. This is incredibly important because as much as all of us would love to own dividend companies that pay a lot of their profits back to shareholders, it is unsustainable because that means they're at risk of cutting their dividends in the future or putting their company in jeopardy and massively increasing their debt. And there's a lot of bad things that can happen if you pay too much of your dividends to the shareholders, which is why I'm really going to zone in on the dividend payout ratio because it tells me what percentage of the profits are being paid back to shareholders. Like, for example, if they pay 100% of their dividends back to shareholders, that's obviously a bad sign because there's no way they can increase their dividends every single year. And that's what I'm really zoning in on, is a reasonable dividend payout ratio so that they can continuously pay their dividends every single year and increase their dividends every single year. And the lower the dividend payout ratio, the safer it is. Now, the only exceptions where the majority of their dividends are paid out to shareholders are real estate investment trusts and master limited partnerships, which have tax incentives to pay out a lot of their profits back to shareholders. And that's why they're actually not called dividends, they're called distributions. So the first company is Algonquin Power, which is a power and utility company. Now, I really like this company because they focus a lot on sustainable energy. And over the past 10 years, they've had consistent earnings and cash flow growth to consistently grow their dividends in double digits over the past 10 years. Now, one thing that makes me nervous about Algonquin Power is its payout ratio, which is obviously over 100% if you're looking at past earnings. Now, when I download the investors' presentations, I'm seeing that they are targeting a payout ratio that's a little bit lower, between 80 to 90%, and they believe this is sustainable. Now, whenever I see dividends that are over 80%, I get a little bit nervous because I want my dividends to grow every single year. I don't want them to be flat. And I definitely don't want them to get cut. So this one I'll monitor closely. Now the next one is Riocan, which is traded on the Toronto Exchange. Now this is one of the largest real estate investment trusts in Canada. Now they manage shopping malls. They also are into residential development. Now the thing about Riocan is that this company is not a dividend grower, meaning they don't grow their dividends double digits every single year. In fact, they barely grow their dividends because the reason why I invest in them is I want a predictable source of cash flow. And it was super enticing when they had a huge drop during the pandemic. Now with REITs, don't expect home runs. You're just expecting repeatable distributions. And Riocan did survive when the economy shut down and surprisingly decent during the pandemic. Now, despite a little bit of distributions cut off earlier during the pandemic, I was very empathetic because obviously the economy was shutting down and I was okay with it because I was really expecting the company to turn back around, given that their asset value was more than their market capitalization. Now, looking at the next 5 years in their investors' presentations, I could see that they're targeting 10 to 12% return on investment, which includes their yield plus the increase in their market capitalization, because over the years they're going to expect their rents to increase, their assets to increase, and therefore the value of the REIT to increase, which is pretty reasonable. Now, looking at their adjusted funds from its operations payout ratio, which is different from the earnings payout ratio for other companies, because this is a REIT, so we need to look at the AFFO payout ratio, which is a fancy term to say what is its funds from its operations, its rental income after all expenses, were the profits. And that's what they reward shareholders with. And it's a pretty healthy number right now. Hey everyone, big announcement here. I'm opening up enrollment to my next cohort, to my Financial Freedom Accelerator course using stocks. So if you want to learn to create multiple streams of income using stocks, like $500 to $1,000 per month, I share all the ways to do that and how to do it, including developing an investment plan, aligning to your vision and your goals. So if you are interested in learning more about this program, delivered by someone who talks the talk and walks the walk, and you want to get early bird pricing, well, you definitely want to sign up on the waiting list. Check out my link below in my pinned comment. So let's get back with the video. Now, the next company is Telus, which is one of the biggest telecommunications company in Canada. And during the pandemic, I made a bigger position in Telus because, well, they dropped significantly. Now, I like owning them because they're an essential need in Canada. Now, looking at their payout ratio, this is a little bit worrying because it's so high. Now, one of the comforting things is that when I go to investor relations, I'm very happy to see that their long-term dividend payout ratio target is much lower. Their long-term payout ratio is 60 to 75% of their free cash flow, which is really, really good. And they still plan to increase their dividends over the upcoming years. So this is one I'm going to be closely monitoring because obviously in order for them to increase their dividends, they need to grow their revenue, grow their earnings, growing their cash flow over time. I mean, grow, and make a lot of dough in order to actually distribute more dividends. So this is one I'm going to be monitoring very closely. Now, the next one is TD Bank, which is one of the largest banks in Canada. Now, I actually really like TD Bank because of their investing platform. They have a lot of webinars, which very privileged to be featured on. I also just like their Thinkorswim trading platform, which is actually much better in the United States. It's not readily available in Canada, but I see a lot of growth in their wealth management sector. Now, TD Bank is one of those sleep well at night type of companies. Like, they've been around for a long time. They've been paying their dividends for a long time. And if you look at their payout ratio, it's really low. It's super reasonable. This is something that gives me comfort knowing that, look, they have a lot of money to distribute back to their shareholders over time, and it'll be up to them how much they will increase. But to me, it's comforting that they will increase their dividends over time like they have in the past 10 years. And given interest rates are rising, well, that means the banks are actually making more money. So that means their revenue and the earnings and their cash flow should increase, which would support their dividend increases. Now, the next company is Appl, which is a very large pharmaceutical company in the United States. Probably familiar with Botox, right? Well, they own that. So with Appl, I made this position because they had a very attractive valuation back a year and a half ago. And this is around the time Warren Buffett was also making a position in the company. And the risk versus reward ratio is just astounding. Now, of course, now its valuation has gone back up to fair value. But for me, I'm not planning to sell it. they're paying their dividends. They've been increasing their dividends for a very long time. If they continuously do that and their payout ratio can sustain it, which is around 80% right now, which is a little bit high for my own personal comfort, but still okay. And as long as they increase their revenue and their earnings and the cash flow, then their dividends should increase. So as long as I see that, I'm keeping this company. Now the next one is Granite, which is another real estate investment trust in Canada, and they focus on warehouses, logistics, and industrial properties. Now, I invested in Granite because of Amazon. Amazon was just growing massively and they need warehouses. Well, so obviously it just made sense to invest in Granite Realty. Now, I don't expect rock star performance from this company. I'm expecting predictable distribution. And this is one of the rare real estate investment trusts where they've been increasing their distributions every single year, which is phenomenal. Now, in terms of looking at their payout ratio, which is looking again at their rental income minus all the expenses, whatever's left over is given back to their shareholders. Now, the thing about REITs, they give the majority of their profits back to their shareholders because there's huge tax incentives for these trusts. So you can see that their payout ratio is 80%, which is still very healthy. So as long as they stay healthy, grow, make a lot of dough, then I'm cool with keeping this company. Now the next one is Fortis. You're probably super familiar with Fortis. This is an electric and gas utility company in Canada and the Caribbean and in the United States. Now I'm holding this because who doesn't like utility companies because they're a basic need. And this company was founded in 1885, so they've been around for a very long time and they have a long history of paying their dividends and growing their dividends. If you look back the past 10 years, they've doubled their dividends, which is amazing. So when I look at their payout ratio, if I'm looking just at earnings payout ratio, it's decent, 80%, little high on the higher side. But because this is a utility company, we gotta look at this free cash flow because it's got fixed contracts. That's what we're relying on, is their cash flows, and it sustained the dividends. Okay, so when I look at the free cash flow payout ratio, then it's much more reasonable. We're looking at a sweet 37%, which means that they can increase their dividends for a long time. So I think this is very sustainable. Now the next company is Microsoft, a beloved tech company that I'm sure we are all familiar with because I'm sure a lot of us use Windows or plays Xbox or uses their cloud services. So with Microsoft, this is not a company that I'm really heavily relying on the dividend income because the yield is so low. Now in the long term, I do expect Microsoft to become a much more mature company, as long as it doesn't reinvent itself every single time. I mean, reinventing itself is great because that company is much more valuable, which makes the stock much more valuable. But if you're relying on dividends, this is a much lower yield. But if you're in it for the long term, it could pay big time in the future. Now, the next company is Appl. I'm sure all of us know Appl. You know, I'm sure a lot of us know someone who has an iPhone or iPad or AirPods or Apple Watch. So, and they also have a huge subscription business. So they are one of those magnificent companies that know how to make money. Now, this is another company that has a very low dividend yield, but I do expect that Appl eventually will become a super mature company like on the S curve. And when it gets into that super mature company, then they would pay more of their profits back to their shareholders. So this is a long-term game for me. In the meantime, I really appreciate the fact that they increase their market capitalization because the company is more valuable, which gives me a lot of capital growth. But in the long term, I do expect predictable dividends that will increase every single year. And they've been doing that. It's just that relative to the stock price, it's a very low yield. Hey everyone. Now, if you want to learn how to build a dividend growth portfolio where you own a bunch of high quality dividend stocks that grow their dividends every single year, what to look for, check out my ultimate guide to dividend growth investing. It's free. Check out the link in the pinned comments. In the meantime, if you want to learn more about dividend stocks or stock analysis, and a lot of them are Canadian companies, check out this playlist up here. Anyways, I hope to see you in the next video. Bye.